You are listening to The Investor Way with Sam Ball and Jonathan McEwen. If you enjoy the show, please subscribe and follow us on Twitter at TIW Tweets.
Hello and welcome to The Investor Way with myself, John McEwen, my co-host Sam Ball. This week on The Investor Way, we have a retail special with Next, Dunelm, TUI, JD Sports, M&G, and our US company of the week is Fiverr. Sam, should I kick us off with favourite of the show, Next?
Absolutely. First retailer.
First retailer. So clothes retailer specifically, they had their half-year results out last week with half-year sales rising by 5.4% to £2.6 billion, helped by rising wages and exceptionally warm summer weather in late May to June, which significantly boosted the sales of their summer collection. Pre-tax profit was up 4.8% to £419.8 million, driven by top-line growth and a 3.2% increase in own brand full-price sales. Free cash flow improved from £130.3 million to £438.1 million due to higher amounts of cash generated by the underlying business. Net debt, including lease liabilities, improved from £1.9 to £1.7 billion. Full-year pre-tax profit guidance has been raised from £845 to £875 million, and Next completed a further £167 million worth of share buybacks in the first half and expects to spend a further £52 million in the second half. An interim dividend of 66 pence per share has been announced, and the shares were up about 1.5% following the results. In terms of valuation, Next has a market cap of around £9.2 billion and trades at 13 times forward earnings, which is lower than its 10-year average of 14, with a dividend yield of 3%. I thought these results were very impressive given the current climate, and fantastic that full price sales are increasing. Also double-digit growth on the website, which now accounts for more than 50% of sales. And not just that, but they grew sales internationally by 18%. I think Next is a business that you should never underestimate. It's probably one of the highest quality retailers that we've got listed on the FTSE 100. And it's, I think, a similar story every time we cover it. It's always beating expectations. So it remained on my watch list, and I'm regretting not buying it 2 years ago when we started covering it. But yeah, what do you think of these results, Sam?
I think they're pretty good. I know like the sales increases are slightly below inflation, but I think given the environment we've been in and where Next is positioned in the market, I think it's pretty good. Yeah, it's just a very well-run business. I know we say this every time. Returning cash to shareholders. They don't really, they're not spending money on like stupid projects or anything like that. Yeah, I think they're a very good set of results. I think Next is a very well-run business, and it is a stock that has been on my watch list for a couple of years as well, but I've just never pulled the trigger on it, as I've been pretty close a couple of times because I do like the business. I would agree. I think it probably is the best retailer we've got in the UK. It's just very, very well run. It's made very good use of its distribution network with like the click and collect and the proportion of sales coming from online. I think for any sort of UK retailer that's looking to increase their online presence, I think Next is basically the blueprint of what you should be trying to achieve.
Yeah, and I suppose Inditex, though not UK listed, is another business that's sort of comparable in that sense, but I appreciate it's operating more on the continents. That I think you'd agree is quite similar.
It is, especially for a retailer, and given the amount that they will sell in the retail stores. I do think Next is a cut above everything else. So just in terms of the proportion of sales that come from online for what was a traditional retailer prior to the internet. Whereas I think Inditex, is probably possibly the best of the rest, but it's still some way off Next. I think, what was Inditex? Is that like a third or something?
Something like that.
So
I mean, it's
still
growing,
a big gap.
but yeah.
But Yeah.
And Inditex does trade at a premium to Next. I haven't checked just for this episode, but historically it certainly has.
Would you rather have Next or Inditex?
At the same price?
No, at the current prices.
Oh, I'll go for Next.
I'd agree. I actually think Next is the better business, though. I don't really understand why Inditex is a very well-run business, but I don't understand why it trades at a premium.
Yeah.
Or such a premium.
Yeah.
It's like 20 times earnings, isn't it?
It's something more like that, yeah. And I think this is the thing, every time we do cover Next, it's never very expensive.
No. It's a strong...
I'm not sure why that is, whether it's just reflecting it's listed in the UK as a retail, but even then, like if you compared it with ABF, for example, it's probably about the same price. And I would say I don't dislike ABF at all, but I'd have Next over ABF, I think. And it's a similar valuation.
I do wonder if Inditex commands such a higher price because it's so much bigger as well. Like everyone knows it. The biggest stock listed in Madrid, the biggest or one of the biggest fashion brand in the world.
Yeah.
I think we're a good example of it. We're a UK podcast, and every sort of 3-4 months we'll sit and cover Inditex. How many Spanish podcasts will be sat covering Next? It's probably, I'd be surprised if there's any.
Yeah. Okay. On to our next retailer then. Yeah, it did well during the pandemic. How's it doing now?
So our next retailer, it's another good retailer actually, or it has been the last couple of years whenever we've looked at it, but it's Dunelm Group. So Dunelm Group, for anyone who doesn't know, they are the UK's leading homewares retailer, and they have come out with their preliminary results for the 52 weeks to 1 July 2023. So total sales were up 5.5% to 1.63 billion. However, that's if you do 52 weeks versus 52 weeks. Last year was a 53-week period. So if you were to do it based on that, it would actually be only up 3.6%. Digital proportion of total sales is up from 35 to 36%. So actually that's another very good one. Not as good as Next, but 36% digital sales is pretty good. Gross margin is down slightly from 51.2 to 50.1%. The operating cost to sales ratio is up from 37.5% to 38%. Profit before tax is down 7.8% to 192.7 million, and the diluted earnings per share is down 8.6% to 75p a share. Free cash flow is up 7.4 million to 160.4 million, and net debt is up 6.9 million to 30.7 million. They've highlighted continuing strong sales growth of 6% as customers responded well across the breadth of our expanding curated product range. They've highlighted a further 40 basis point market share gain in combined homeware and furniture market. Active customers grew 2.8% with improved customer retentions, and 3 new stores were opened, including 1 relocation. And they continue to see a strong payback, underpinning confidence to accelerate openings over the next 2 years. Said profit before tax decrease of 193 million reflects tight control of margins amidst inflation in their operating costs and their ongoing commitment to investment for the future. And they've said they've highlighted that the free cash flow of 160 million has a strong conversion of operating profit to cash of 81%, and that's up from 70% a year ago. 163 million in total was returned to shareholders during the year, and that's on a market cap of 2.12 billion. So that is a pretty decent amount. So that's about 7.7%. So that's very good, actually. And they've said that over 1 billion has been returned to shareholders in the past 10 years. They've highlighted that the long-term compound annual growth rate of sales is still hovering around 10%, with over 85% of their growth coming from market share gains rather than price increases. And they've highlighted that they think they've got more opportunity in a fragmented market. So the UK combined homewares and furniture markets, excluding kitchen and bathroom furniture, is 24 billion, and their market share is only 7%. I think they could get it a little bit higher. I don't think it's going to be a market where you have one firm dominating, but I think if the biggest is at 7%, if they were saying, for example, like their long-term target is to get to 10%, I don't think it's outrageous, especially if they've got the ability to keep opening new stores. I don't think it's unreasonable to point to how big the market is and the fragmentation as an opportunity, as opposed to some where you look at the fragmented market and you do kind of think, well, there's a bit of a reason it's fragmented, like with Halfords, which we've covered before. And they've said recent openings include stores outside of our traditional size and location. Continue to see strong payback in under 3 years. I would highlight these stores are almost certainly going to be leased, which is why the payback is so quick. And then they've said for the next 2 years, they expect to see 5 to 10 new or relocated stores per annum. So in terms of the recent stores, the most recent ones in the last couple of years, they've tended to be the smaller superstores compared to typical superstores. I'm not 100% sure what the difference is, but well, I imagine it's the size actually. So in terms of valuation, the business trades at a P/E ratio of 14 and yields 4%. I think these results are pretty good, especially as John alluded to at the beginning, they did have a very good COVID, but I do just think they're a very, very well-run business. I think they've had a very good COVID. They've not had the drop-off. Yes, the growth has slowed, but we've seen that a lot of businesses, and there's a lot of people where they were bought home stuff when they're sat at home, and now these are people that would have possibly bought it in 2023, 2024, and they've just pulled that demand forward. So I think to still be growing is quite good. Total sales for the previous 5 years: 2019 year 1.1 billion, 2020 1.06, 21 1.3, 22 1.58, and now they're up to 1.63. So apart from the COVID wobble, there's just a clear trend. And I know some of it might reverse, or you might have some people where they've done projects and they don't go back to it. But I think if you were to compare this to businesses that we've covered that have benefited from COVID, such as like Kingfisher has seen more of a drop-off, or B&M, whereas Dunelm are actually hanging on to what they got in COVID, and they're continuing to expand. So I think this is a really good set of results. I think it's a very good business. I think at 14 times earnings with a yield of 4% is pretty reasonable. My only issue with Dunelm is, as good as I think it is, if you were wanting a retailer, can you get a better one at a lower price in Next? John, what do you think of the valuation and the results?
Yeah, I would say that you can get a better one in Next, and that would probably be the difficulty for me in looking further at Dunelm, or to be buying Dunelm shares. But like you say, well-run business, got a good quality product, value proposition. I suppose if you're being critical, how much growth is ahead of it in the fragmented market, I guess they would make the argument that there's quite a lot and grow that market share. But I guess that is a question mark, and it's not as cheap as Next, so I probably wouldn't go further than that at the moment. But of those sort of retailers that I think of as higher quality in the UK, Dunelm would be amongst them for sure.
What do you think of it in comparison then to other businesses that have had that COVID bump and then not gone on? So, for example, a Kingfisher.
Kingfisher, yeah, key example. And I would definitely rather have Dunelm than Kingfisher. I think it does demonstrate that there is more demand. It's not as cyclical as some of those companies, and certainly Halfords, which is probably the worst example overall of those businesses. So yeah, I think it is testament to Dunelm for maintaining and continuing to grow. It is impressive, and no mean feat.
We see if our theme of quality businesses is about to continue.
Yeah, so this is it obviously isn't a retailer, but the travel group TUI, which we have covered a few times before and never particularly liked it, had a trading statement out which is more positive, which has reconfirmed expectations for the full year. It expects to report significantly higher operating profit for the fourth quarter and the full year. Summer 2023 bookings are up 5% on last year in markets and airlines and stand at 96% of pre-pandemic levels. The summer season has been extended to November to cover increased demand in certain destinations, and winter bookings for the current financial year are currently 29% sold. Cruise occupancy rates are up 9%, and the group expects to operate a full fleet of 16 ships in the winter season. and TUI shares were up over 6% on the news. In terms of valuation, TUI has a market cap of £2.3 billion and trades at 1.23 forward price to book, compared with the 10-year average of 3.65, and it doesn't pay a dividend. Promising statement from the group, but it's still in a really distressed position. It has a huge amount of debt. That's even after the 1.8 billion euro equity raise. And I think also, going beyond that, it is an industry that's in sort of structural decline of the traditional travel retailer. It's commoditized with very price sensitive customers. And I think in the long term, unless you have a niche, maybe like Trail Finders rather, or Exodus, I don't see a future for the traditional or the more traditional model like TUI. Obviously, it's very cyclical, but I think it's the commoditization with the internet. I just don't see it longer term. So it would be, I'd avoid it with a barge pole basically. But encouraging from their point of view that things are, recovering to some degree. Sam, what are your thoughts on this trading statement for TUI and its future prospects?
Yeah, I wouldn't touch it with a barge pole. Pretty similar to what I said last time. It is just completely uninvestable. Even if it didn't have the debt, don't like the industry. I do find it interesting just to sort of keep an eye on like the wider economy and stuff. I think it does give you some pretty good indicators and stuff. I'm surprised actually that it's not still I know it's 96% of pre-COVID levels, but I am surprised that it's not back to where it was yet. I know it's nearly there. But like this summer, it just doesn't, like when you get on a plane now, it does not feel like anyone really cares about COVID anymore. Or like it's, people have moved on. So I'm surprised it's not, back at or over the pre-COVID levels. I think it'll be interesting to see what it does next year, because you think if it's gotten that close next year, is it going to finally go past it? But the issue is it was in a very tough industry anyway, and then everything shut down because of COVID, and it just had to take on so much debt to survive. And then now it's in the position where we're back out of the pandemic. It's still in an unattractive industry, but with way more debt than it had before and interest rates much higher. It's just a terrible, terrible position to be in.
I think that's about all there is to say on it. Shall we move on to, again, a higher quality retailer, JD Sports?
JD Sports have come out with their half-year results, and revenue is up 8.3% to 4.784 billion. The gross profit percentage is down slightly from 48.5% to 48%. Operating profit before adjusted items is down 4.7% to 398.4 million. And profit before tax and adjusted items is down 2.6% to 373.5 million. I have gone with the adjusted figures just because they've adjusted down, which is usually a pretty good indicator that they're being honest. And it looks like a lot of the adjustments are mainly to do with, I think it was a gain on a derivatives contract or something like that they've adjusted out, which is fair enough. Basic earnings per share was up 29.9% to 4.65p a share, and the interim dividend per share is up 130.8% to 30p a share. Group revenue growth was 8%. However, on an organic basis, it was actually 12%, and that reflects the impact of divestments of non-core UK assets. Premium sports fashion delivered 15% organic growth or 9% like-for-like, with further market share gains in key regions. Gross margins were robust at 48% and well above pre-pandemic levels. First half is a more normal promotional environment. They've highlighted strong performance from the North American premium sports fashion business, with organic growth of 15% and like-for-like growth of 9%, with EBIT up 12%. Balance sheet has net cash of 1.276 billion, up 263 million versus 12 months ago. Inventory levels are well managed and in line with sales growth expectations. They're on track to add over 200 new JD stores globally by January 2024. And they've got strong trading from the US complementary concepts, which are Shoe Palace and DTLR, in America. And then new distribution centers are on track, and they began a loyalty trial in the UK. They ended the period with 3,347 retail stores. That's 43 less at the start of the period because of the strategic divestment of 66 non-core premium fashion stores. And for North America, they've said all our North American businesses achieved good organic sales growth, with the three largest, Finish Line / JD, DTLR, and Shoe Palace, delivering between 13 and 17% organic sales growth. I would mention I think this is very positive, because one of the issues we've had in the past looking at this business is with the US acquisitions, are they diluting the quality of the brand? In terms of, I don't know anything about Shoe Palace. It might be fantastic, but is it in the US the equivalent of what JD is in the UK? And that JD is quite a cool place. I don't know if Shoe Palace is or not, but since they've taken it, it is putting up the numbers. Although I am still skeptical of the strategy. They've also said that due solely to the UK divestments of non-core fashion businesses, revenue in our other sports fashion business was down 16%. And then if you go into the analysis by segment, so total revenue 4.79 billion. 1.6 billion is from the UK and Republic of Ireland. 1.4 billion is from Europe, and 1.5 billion is now coming from North America. And then rest of the world is 255 million. So North America, that's actually, well, we've covered that, but that's grown a decent amount. UK and Republic of Ireland's down, but that's because they've got rid of some of the non-performing stuff. But in terms of geographical split, that's pretty good. If we split it by channel, retail stores make up 3.6 billion of the 4.8, and multi-channel is 1 billion, and that's actually down slightly. If we do it by product type, of the 4.78 billion, footwear is 2.74 billion, apparel is 1.49 billion, accessories at 299 million, and other is 251 million. So yeah, it's quite nicely diversified, I think, actually, certainly geographically. In terms of the valuation, the business trades at a PE multiple of 11.38 and has a yield of 0.5%. JD has historically put up some fantastic numbers, but it's now a £7.5 billion market cap. So I do question how long it can continue to do this for. The solution thus far has been to acquire the US businesses and start, trying to do to them what they've done in the UK with JD and in Europe as well. So far, it does look to be going well. I think it will be interesting to see if they do start to rebrand more of the US businesses into JDs, or whether they will leave them as Shoe Palaces. But I think for me, if you feel like you understand the business and you like the business and you believe in the strategy, I think at a PE of 11.38, it's pretty cheap. My issue is I'm not sure I do understand the business well enough, in that I'm not massively in love with the industry. I think we have covered Nike and Adidas before on the show. And although JD gets some exclusive trainers and stuff, Nike and Adidas, their focus is clearly to direct consumer. So JD eventually is going to be competing more and more with Nike and Adidas and all these other brands themselves. So are they just going to be left with the second-rate trainer brands? But then I just do not know how strong some of these other brands are. And I think they're such a key part of the investment case that, because I just don't understand Shoe Palace compared to how I understand JD as a consumer, I think for me, it probably does just go in the too hard pile. But I can see why someone might find it attractive with its track record and the valuation and the brand as well. But there are some risks there, which I think possibly is reflected in the valuation. John, what are your thoughts on the results and the valuation?
Good results. Again, very high quality business. I think the valuation is fairly inexpensive. My main concern would be the move to direct consumer. I know that that's not something that's going to happen overnight, and you're not going to see Nike and Adidas overnight going 100% like that. But every time we cover those businesses, that number of direct consumer is gradually increasing. And with a market cap of 7 billion, it's grown a lot, but it's nothing like the sizes of those big brands. So that would probably be enough to put me off. And like you say, I'm not familiar with some of those like acquisitions Shoe Palace and what their image is. Are they the equivalent, or are they turning it into the equivalent of JD? And does it have that sort of appeal that it obviously does here with the youth market, I suppose? So no, not one for me, but very interesting to follow and see how it does continue to expand.
One final point, I've just spotted this now. You'll like this. So where they've divested of the non-performing, basically parts of the UK apparel business, can you guess which group has bought them?
Okay, in the UK, it's very easy. It's going to be Mike Ashley and Frasers.
Now, this was not pre-rehearsed. I just want that on the record. You've nailed it.
It's literally, well, and anything on the high street that you can imagine, he'll be around.
Right, should we move away from the high street now?
Yes, okay. It's probably an industry that you don't like either, Sam. I'm sorry. It's M&G, which is, well, largely an asset manager that was spun out of the Prudential a few years ago. So M&G reported first half assets under management and administration of £332.8 billion. That was down 2.7% from the start of the year, driven by negative market movements and a small net client outflow. Excluding the closed heritage portfolio, there were net inflows of around £700 million, and momentum in the wholesale asset management business accelerated further, helping to absorb the expected outflows in the institutional asset management business. Underlying operating profit rose 30.9% to £390 million, was largely due to higher interest rates, which improved profitability for the annuity portfolio. Since ending the half, M&G has re-entered the bulk purchase annuity market with 2 deals, its first since closing the book in 2016. The shareholder Solvency II coverage ratio, which is a measure of the balance sheet strength, was flat at 199%, and an interim dividend of 6.5 pence per share was announced, which represents a 5% increase. The shares were up over 3% in early trading. In terms of valuation, M&G has a cap of £4.8 billion and trades at a forward price to book of 1.34 and has a prospective dividend yield of 10%. These seemed like very good results to me in what's quite a technical industry, with the annuity market heating up and feeding through. They also have the new M&G Wealth platform, which is able to offer advisors an all-in-one platform, funneling assets into the M&G funds. And also the group's planning to reduce the relative debt levels further and cut costs. It was a less attractive part of the Prudential, which is spun out, and it looks like it's beginning to turn around and become more appealing. I think that there have been rumours in recent months of it being a takeover target. It does have a very decent dividend yield, which it has maintained since it was spun out, I think, in 2019. So if you have held it since then, you'll have done very well. It's not an industry that I would really be looking to invest in. I think it is quite difficult as a retail investor to be able to analyse it in any great depth. I think that's, as we say with a lot of these companies, does sort of put it in the too hard pile. It is interesting to see how it goes. I did own it for a time, and that was because I had Prudential, and then when it was spun out, I got some M&G shares, which are subsequently sold. So I probably wouldn't look at it again. I don't know what your thoughts are, Sam, or similarly.
Pretty similar. I didn't like it before. I don't think these results are actually terrible. They'd definitely be helped by interest rates, but they're not terrible results. But it's such a competitive industry. I've already got Hargreaves in my portfolio, which was probably a mistake because I just think it is an industry that's becoming increasingly commoditized. And the other issue I've got is I don't like them re-entering the bulk purchase annuity market. Not because it's necessarily a bad thing or it's like not a good idea. They could do very, very well off it. But I think unless you actually work as an actuary, how do you analyze that? You know, we have stuff where regularly we'll have, usually at least one company a week where it goes in the too hard pile. I'd say analyzing that, I mean, there needs to be almost a separate pile for it, because this isn't the same as putting JD in the too hard pile, because I don't know what shoe palace is like. This is just another level of technical that I just wouldn't. It would just be stupid for me to even try. I think if you've got the knowledge and the expertise to be able to do that, so if you do work for an actuary, then maybe it's worth having a look at. But otherwise, I just think there's so many businesses out there that are simple to understand. You don't need to start playing with this.
Yeah. Or you can buy the index, but it's a bit boring. On to, well, an easier company to understand, Fiverr.
Yes, so Fiverr, they are very similar to Upwork, which we covered last week. I think they're trying to move more into Upwork's territory, but I do view them more as like one-off engagements. So like, as an example, our intro, we got that on Fiverr, and our logo, we also got on Fiverr. So, and they were both just one-off creative jobs, which is how I do see it. Although since we got the podcast logo and intro, I haven't actually been back on Fiverr, but at some point I might need something like that and I'll pop back up. But yeah, so very good for that sort of like outsourcing and all that jazz. But they have come out with their half-year results. Revenue was up 5.1% year over year to 89.4 million for the second quarter of the half. Active buyers was flat at 4.2 million. Spend per buyer was up 2% year over year to $265. Take rate was up 90 basis points to 30.7%. This is quite interesting because this is significantly higher than Upwork's take rate that we did last week. But at 30.7%, it's like when you cover, like not when we cover, but when you look at like auction houses and stuff, it's extortionately high, and they're taking it on the buyer side and the seller side. But I mean, it's something for Upwork and Etsy and other businesses to aspire to, but I do wonder with 30.7%, at what point is it actually so high that it puts people off? Anyway, gross margin is 82.5%, which is obviously excellent. And they actually now have net income of $200,000 under generally accepted accounting principles. Normally they have to do several adjustments for net income. Now, this is obviously absolutely tiny, but it's nice to see. And in terms of financial outlook for the full year, they are forecasting $358 to $365 million of revenue, which would be 6 to 8% year over year growth. And in the highlights, they've said that Fiverr accelerated its upmarket strategy with the recent launch of Fiverr Business Solutions, a suite of product offerings which allows larger companies to access and work with freelancers across multiple use cases and engagement scenarios. This launch also includes the all-new Fiverr Pro, our premium marketplace offering. They've also launched Fiverr Certified, which expands their go-to market channels through partnerships with tech vendors that have large SMB communities. By creating dedicated partner marketplaces, Certified provides partners and their customers with purpose-built service offerings fulfilled by certified experts. And they're also introducing Fiverr Neo. We rolled out Fiverr Neo, our groundbreaking matching tool, leveraging the latest neural networks technology and Fiverr's data assets. Fiverr Neo provides an all-new experience for customers to express their needs and be matched with the right talent. And in the growth strategies and recent progress, they've said that the number one strategy is to bring new buyers onto the platform, which is not a terrible idea. So they've said in the 12 months ended June 30, 2023, active buyers were 4.2 million. As we accelerated our pace in upmarket investment during the quarter, we've also shifted more acquisition budget towards higher value buyers and reduced investments in certain channels that mostly attracted low value customers. We expect this strategic decision will impact the number of new buyers joining our platform this quarter, and in turn, the overall buyer number in the near term. It will ultimately drive a better buyer mix and improve spend per buyer, lifetime value, and retention. And then it's really interesting because what they do is, one of the reasons that historically this has not been profitable is because so much of their basically revenue is just plowed straight back into sales and marketing. And what they actually do is they take the sales and marketing expenses and they measure it. And for each quarter, they will basically take the sales and marketing spend and compare that to new customers from that quarter. And they call them a cohort. And what they can do is they will track that cohort over time. So they basically know what the return on that sales and marketing is. So as an example, as of June 30th, 2023, revenue from the second quarter 2020 cohort reached 3.9 times the initial performance marketing investment, which is obviously a fantastic return, and they're still going to continue to get that. So although the business is growing and they're pumping it back in, it's not like they're doing it just to sort of sustain where they are. It's very clear that the lifetime value of the customer is significantly higher than what they're spending to acquire each one. And then they've also said the percentage of core marketplace revenue coming from repeat buyers continues to climb, reaching 65% for the last 12 months compared to 64% last quarter. Another one of the strategies at the minute is go up market, which we talked about a bit earlier, but it said in the 12 months ended 30 June, spend per buyer increased 2%. We continue our efforts in attracting high-value customers from the top of the funnel, improving conversion of those customers with differentiated product experience, and expanding our catalogue and supply to fill larger and more complex products. Basically, a lot of the new tools and stuff they're rolling out is to tailor for those larger businesses and the larger clients. So they've said the all-new Fiverr Pro combines our original Pro program with Fiverr business environment we built over the last few years to create a comprehensive premium offering of the marketplace. Under this premium offering, customers can access a pool of fully vetted pro experts across all verticals, have a unique dashboard with tools to easily manage their projects, track project status, collaborate with in-house team and freelancers, and create consolidated reports. Utilize enhanced payment capabilities that include net term payments, receive access to a dedicated success manager who will provide white glove services such as onboarding, troubleshooting, talent matching, and consultation services. We also have project planning experts available who can provide end-to-end project management to pro clients. And then they've said we continue to increase our international expansion efforts in the UK, Germany, and France, which are important growth markets. And then one thing that's very interesting is if you go onto the balance sheet, they've got 454 million of convertible notes on there. And that's on a market cap of under $1 billion now. The cash, so the 450 million convertible notes, cash is only 191 million. So obviously that's significantly more than the cash. So first thing I've done is have a look at these convertible notes. And it says, so these notes were mainly issued in 2020. And it said they issued about 400 million of convertible notes in 2020 with a conversion price of approximately $213 per share, which was a premium of 40% at the time they issued them. Now, the current share price is $24 a share. So I don't think anyone in their right mind is going to pay $214 a share to convert these notes. So they're going to have to pay back the 450 million. The notes mature on the 1st of November 2025. However, they've had 5 years of these notes at 0% because they were convertible. So it's been a cracking deal, but obviously they need to come and repay it. However, they've got 162 million of cash on the balance sheet and cash equivalents. And then they've got another 450 million of marketable securities. So then when you go into the SEC filings for the December 2022 year, so they've said in there that the marketable securities at that date were 431 million. And that's comprised of treasury, corporate, and municipal bonds. Yeah, I'm not entirely sure why they've done it. They've gone and issued 400 million of convertible notes, and then they've not really done anything with the money. They've just put it in treasury bonds. I guess the logic was that it's at a 0% interest rate, so they may as well get it for the 5 years. So in that sense, it's I guess it is fairly smart. But at the same time, if the share price had rocketed and people had been able to convert and diluted the shareholders, for money you're not going to use, I do question what that was for. But anyway, they're not going to get converted unless something incredible happens over the next 12, 18 months with the share price. But I just thought that was interesting. In terms of the valuation, the business trades at a market cap of $918 million. That's 2.67x sales and 3.28x gross profit. Now, there's no net profit over 12 months anyway, because they're ploughing it back into sales and marketing, which we've discussed. But when the return is so high, I don't have an issue with that. But yeah, 3.28 times gross profit. I think this is a business that in the future, especially with such a high take rate, could have very high margins. Certainly if the gross margins are anything to go by, because they're 82%. So yeah, I think it's actually pretty cheap. The share price has taken an absolute hammering. It's down about 90% from the peak. I think I bought it when it was down about 2/3 from the peak, and I've added at a couple of different points. So I think I'm down like probably like 60% on this. I don't think they've got any issues going bust in the next few years with that amount of cash on the balance sheet. If they really have any issues, they can just switch off the sales and marketing. I think this is like Upwork, which we covered last week. I think this is a very, very cheap business. And I'm not actually sure why it's trading so cheaply. Like Upwork last week, it's had a lot of growth pulled forward in the pandemic, and it's still growing 6 to 8%. It's not amazing, but I think it's going to get back to those high growth figures once you've sort of gone over that period where the pulled forward demand would have been. So, John, what do you think of the results and the valuation?
I thought they were pretty good. And valuation wise, I don't know, because I had a big issue with the valuation back in 2020, 2021, but now that sort of disappeared. And I appreciate that it was, they were at extremes of valuation, and that's all gone. And obviously they didn't continue to put up the numbers that, if they're trading at the premiums, you'd expect them to do. But I don't know why now they are quite so cheap. And like I said last week, I think I would probably take a basket approach now and may actually go ahead and buy a little bit of Fiverr and a little bit of Upwork and just start a position. But no, I don't know. I don't know whether I'm missing something or whether it is just the Mr. Market being as Mr. Market is.
I don't know either. I guess a lot of it comes down to, are the lower growth rates just because there's this catch-up period where the pull forward demand from COVID would have been, or is it just going to grow at 6% a year from now on? But the valuation's so cheap that, again, I haven't done it, but if you were to go back in and sort of like knock out the sales and marketing expense or heavily reduce them, is it actually quite a cheap business?
Yeah.
Yeah, it's kind of like when we did Etsy a few weeks ago. It's so cheap and it's buying back so much stock that it almost doesn't need to grow. No, I think it will carry on growing, and I think it will get back to decent growth levels. But if it doesn't, I think it's priced in such a way where it's like, well, that's fine.
Yeah.
But it's like you say, that they were so irrationally expensive at the peak, and we might not have bottomed yet on Fiverr. It continues to go lower and lower, unfortunately for me, but it's incredibly cheap. I think. I know you can't value it with a PE or anything like that, but you don't have to sort of bake too many silly assumptions into like what you're pricing or like what you think the margins can be before you look at it and you're like, well, that is actually really, really cheap.
Yeah. No, I'd certainly agree with you there. Yeah. And I think I suppose we call it digital outsourcing. We are on that structural trend going forward.
Well, that's it as well. Do you think that's a market that's going to grow 6% a year for the next 10 years?
Absolutely not.
Exactly. So of the 6 businesses we covered this week, Next, Dunelm, TUI, JD Sports, M&G and Fiverr, which one do you like the most and which one do you like the least?
Tricky. It's between Next and Fiverr, which I like the most. Might go for Fiverr, actually. The one I like the least would be TUI, which is, by far and away, I think the worst company we've covered this week.
I would agree, excluding Fiverr because I already own it. I do really like Next. Yeah, I know it's quite a boring answer, but yeah, pretty similar.
Would you top up on Fiverr?
So when I looked at these results, so I was saying to you off air, it's bad, but I don't cover the results as they come out because it's in a separate account to most of my other stocks. So I just don't see it, which is good because I don't get upset at the price, except when we look at it once every 6 months. But it also means 6 months have gone by and I literally haven't looked at it. So when I saw it, after looking at this, I'm thinking quite strongly about topping up. But the issue is, I think I've bought it in like 3 tranches already. And it's kind of like how you can buy it all the way down to 0.
Yeah.
Now I'm looking at it and thinking, I don't think there's anything wrong with this. And if anything, it's, more attractive than it's ever been. But it's, do I actually want to do that? Because I don't want to be here in a year's time where it's at 12. And I'm like, well, do I top up again?
Yeah. Yeah.
So I'm wrestling with it because I just think if I do top it up, this has to be the final time. And I think I've already I don't think I've topped up at 24, but I think when did I buy it? I think I bought it at about $90 a share. And then I topped it up at 60, and I think at 40 I topped it up again.
Yeah.
So, based on the price movements, I'm probably due a top up now. But I don't want to do it all the way down to zero. And at some point, you do just have to cut yourself off.
Yeah.
But it's not like a Boohoo where it's crashed and I'm looking and thinking like, I'll be lucky to get my money back. I know Boohoo's not terrible. And if it can get back to some decent growth, but with Boohoo getting back to previous growth figures, I do view it much more of it as an if.
Yeah.
Whereas with Fiverr, I would put it in a different category. So I don't know if, I don't know.
Okay. Well, thank you very much for listening, and we'll see you again next week.
See you next week.
Thank you for listening to The Investor Way. To get in touch, please follow us on Twitter at TIW Tweets. This podcast is for entertainment purposes only and does not constitute financial advice. Neither Sam nor Jonathan are financial advisors. For investment advice, please consult professional advisors.